Welcome. So in this video, I'll be sharing with you some rules that has helped people like Benjamin Graham, people like Warren Buffett, and the likes in building the wealth that they've been able to amass. The truth is, when it comes to building wealth, there are so many aspects to it. There's so many rules to it. There's so many ways to get there, depending on what your own destination is, depending on what your own desires are, depending on what you're looking forward to achieve. But there's some simple rules that we can all follow, and we will somewhat get closer to where we need to be. If you're new here, my name is Stephen Ojo, and on this channel we talk about finance and investing. So if you are into that, if you want to build wealth, then I would urge that you subscribe to the channel and don't forget to like this video. Now I've compiled some notes, and I would reference those notes as I go along in this video. My goal is to try to go straight to the point, because some of these rules are things that we already know, but I hope that you're reminded of these rules and how important they are. So, but the first one is to make regular contributions to an investment fund. For example, an index fund, an ETF, or even a stock. But let's stick with the index funds for a second. And the reason is because people like Warren Buffett have actually recommended, to people like us that we are not professional investors. We are not digging in and out of these financial reports by these companies on a daily basis. And that means that a regular average person is going to be better off investing in index funds than individual companies. And if you then choose to invest in individual companies, then it's recommended that you invest in something that you understand. And that is the second rule. When you're choosing a business that you understand, you've already given yourself a leg up, and that is an advantage. And I'm going to use myself as an example. In the world of the airline business, I understand when companies are making money. And that is because of just the things I see, the things I'm able to experience with the business side of the airline world. So look at the areas of competence and find businesses that you understand. I'm talking about the areas of your own competence, by the way, and look at the businesses that you understand and try to invest in them. This leads to my third point, or third rule, which is to find favorable businesses with long-term prospects. You have to understand that when you find a business that you like, think about the longevity of that business. Do you think it's going to be around in the next 5 years? Do you think they'll still be around in 10 years? That would help you decide on how you plan to hold on to that company. One general rule is to find a company that is operated by honest and competent people. The reason behind this is very simple. It's not even far-fetched. If you think about FTX, see what happened to the company. And there's so many companies like that will promise you, 10, 15% returns on your investment, but they're doing shady things behind doors. And that is why you need to make sure that you, first of all, understand the business, but secondly, look at the people that are operating the business. Do they have any track record? Fourth rule, or in this case, the fifth rule, buy at an attractive price. That means you buy these companies at an attractive price. The reason behind this is very easy to understand. Why? Because you don't want to buy them when they are at a peak. You always want to buy them usually when they are at a discount. If you think about what is going on in the stock market now, a lot of companies are being sold at a discount. Now, that doesn't necessarily mean they're sold at a discount at the current price they're selling, but I'm talking about in terms of their valuation of that company, the profit to earnings ratio, and so forth. This would generally give you an idea of what they are valued at, and think about your future prospect as well. Next rule is to maintain a margin of safety when you're investing. Margin of safety in the sense, do not go all in with all the money you have. The other thing is, always remember that you could be wrong. And I'm going to give you an example. When Google and Microsoft started out, Warren Buffett didn't even invest in them because he didn't understand the business. He didn't understand what they would do long term. and it stayed back. It's okay to not get in right away. The business, if it's a solid business, it will be there in the future for you, and you will still be able to make money on it. Next rule is to buy and hold. And most of the time you want to hold for as long as possible, probably forever, unless the fundamentals of the business change. So if you believe in a company and you bought the company, or you bought a piece of the company, then you want to hold it for as long as possible until something changes in the fundamentals. Not because the stock market is going down, not because, there is a recession, because if the company is a solid one, they would ride out a recession. And this leads to my next rule, which is to grab opportunities. There was a saying said by Warren Buffett. He said, when it's raining gold, reach for a bucket, not a thimble. I hope this makes sense. If you think about it, when it's raining gold, you don't want to grab the smallest piece of it. You want to grab as much of it, which means you want to reach for a bucket to grab as many gold coins as possible. And this is in reference to when recession do hit, or when stock prices are down, you want to buy as much as you can. And this is why you also need to keep some money as for reserves, or cash for reserves, for those times when these opportunities come up. The next one is to go against the crowd. Most of us will always want to follow the crowd. If you think about the meme stocks, everybody's buying, everybody wants to jump in and ride a wave. While that may work, it won't work all the time. And in fact, your chances of it succeeding are very low. The next one is to stay in your circle of competence. If you are investing in something that you do not really understand, then you may want to take very minimal risk, very minimal approach into it, because you do not want to lose all of your money. The next point, or the next rule, is to manage your emotions and have some emotional discipline. A good example of this is, if you own a house or a car, you don't go around checking the value of the car every minute. You don't go around checking the value of your house every day. You don't ask for an appraisal every day, and that is because you know that the house is serving a purpose, and you're happy with the purpose for what you're getting from it, for the purpose it's serving. You're happy with it. And same thing goes with these investments, that when you buy them, always understand that they have a purpose, and as long as that purpose has been met, the financials are good, the fundamentals are good, and the future prospect is looking good, then you shouldn't be worried. You shouldn't be checking the balance, your account balance every day, or looking at the stock market every day, because that would make you emotional, okay? Because you're constantly worried about the fluctuations in the market, which is not what you want to do. Now we're going to move to the things that you should not do when it comes to investing. The first one is, do not try to time the market. I'm sure you've heard this over and over again. You cannot always time the market, because we do not know what is going to happen tomorrow. Do not get envious of people making money from risky behavior. And I'm going to repeat that again. Do not get envious of people making money from risky behavior. I think that is self-explanatory. There's so many people that would want to get into very high-risk plays and hope that it goes in their favor. And yes, they may be lucky, but when it comes to building wealth, you cannot count on luck. There needs to be some discipline. Do not bet against the stock price by shorting it. And I'm sure you guys know what shorting means. Pretty much betting that the stock will come down, and generally you can make money that way. But a lot of times these people get smoked. And when it comes to building wealth, we do not want our money to be smoked. Next is, do not buy stocks on margin. And that is because you're borrowing money, and if for any reason that play or that investment doesn't go in your favor, you get what they call a margin call, which means your broker would end up calling you or sending you a notification that you need to make more deposit, or they might actually liquidate your assets. So you do not want that to happen. The next, and I think the last do not here, is do not invest in non-productive assets like gold and cryptocurrencies. Now, a lot of people may not buy that, and there's a reason for that. And I understand why. Because when it comes to things like gold, you can consider them an asset class that is totally different from, stocks. They're commodities. And this type of asset classes generally are okay for short-term purposes, for storing the value of money. But on a long-term basis, they are not good investments. And that is because they do not produce anything. Same thing with cryptocurrencies. They do not produce any form of returns. You're only counting on someone else paying you more for the investment or for this type of assets. One last note, doubling your net worth will not make you happier. If you're not happy with 1,000, if you're not happy with 10,000, you'll probably not be happy with 100,000, and definitely you'll not be happy with 1,000,000. So the point here is we need to manage our own happiness and focus on our happiness from not just material things. And last but not least is to remember that when you do something that you enjoy, every day that goes by feels like another day of play because you enjoy what you do. So find something you enjoy doing and stick with it and build wealth along the way, because over time, things will work in your favor.